5.5%. But we also expect policymakers to maintain optionality here going into the rest of the year and looking ahead to 2024. We are going to get, and this is maybe the big news of the day. We're going to get a new summary of economic projections, so we'll see how policymakers are thinking about the economy, both in the near term, but in the longer term as well. We're expecting to get 2026 numbers. It'll be curious to think what they pencil in for their long run projections of both rates and unemployment and so forth. Let's have at it. Kathryn, what are you looking for today as we head into these last 3 minutes before the numbers come out?
I think the dots plot and a shift therein is of most interest to me. Of course, the summary of economic projections is as well, but John, I think it's generally understood that the Fed is very likely to decrease its core PCE forecast for 2023 year end and increase the GDP forecast for 2023 year end. So things are looking good from the perspective of the Fed. I'm also keen on watching if the Fed talks today about high gas prices and their potential impact, as they usually do have an impact or second round effect on core, and if they mention quantitative tightening, and any comments therein.
Okay, and QT, to your point, basically been running in the background. Do you think that that's working basically as planned, Catherine? If they were to tweak something, what would you be looking for?
Well, we do see rates, the 10-year, and looking here at the highest levels in since 2007. So 10-year treasuries touched their highest level since 2007 in terms of yield. And we do know that the Fed is rolling off at a good pace. I doubt they change too much, but there is going to be upward pressure, I think, on the back end of the yield curve, especially given fiscal deficit issues and especially given that the Fed is very likely going to continue this hawkish policy. And I think, and we can talk about this later, that the Fed is very likely to remain higher for an extended period of time, more so than what the market is currently anticipating.
Okay, Carl, you're our guy for the intersection of bond markets and fiscal deficits. Uh, how should we be thinking about that? Also at the intersection of monetary policy here.
Um, so I think that going forward, the sort of the fiscal situation is probably independent right now of what monetary policy is going to do. Bringing the deficit down, at all is an enormous struggle. I think we have a lot of posturing that's going on right now ahead of potential government shutdown. We're going to see sort of like what the sort of I guess really sort of hardcore conservative Republicans are willing to accept on deficit reduction, but we know it's not going to be much going forward, right? So in the next couple of years, we're going to be limited, I think, in what we're going to see, in deficit reduction, regardless of what the Fed does. And I guess, pushing back to the bond market, I mean, as Catherine said, they have to take that into account because there's going to be a lot of issuance here in the next couple of years. It's just a fact, and there's really no way around that, no matter what we see or what the Fed says. So I think, I'm kind of interested in seeing what the Fed is thinking about the labor market, how they're seeing it going. I mean, I see, relatively good things. I see a slowdown that is, what I would call on pace. But it could get a little bit faster, especially we've seen some revisions in payrolls to the negative. So I just want to see what the Fed is thinking about that for like, I guess what the near term risks are to the
Okay.
economy.
All right. Well, we're heading decision just about 10 seconds out here. Market, no fireworks in markets heading into this. We'll see if there's anything to trade off of in the tea leaves. Did they do nothing? So they're at 5.25 to 5.5%. The median rate forecast stays at 5.6% for 2023. For 2024, it inches up to 5.1%. So that's higher for longer. idea. We have 12 officials seeing this year, while seven see us staying on hold. And Fed is noting that job gains slowed in recent months, but remain strong. Let me just stop there and go back to you, Kathryn. So, first thing. So that 2024 median projection inching up a little bit. Do you make much of that?
I lost you, but in case you can hear me, that's what caught my attention as well, John. Fed
Okay.
2023 median rate forecast stays
We hear you great. Yeah.
at 5.6%. 2024 rises to 5.1%. So even though the Fed in the dots is expecting some additional hikes and then some easing, it's taken back some of that easing, and I think that makes sense. And the reason I think that makes sense is because if the Fed has discarded already recession, that means soft landing is their base case scenario. Then it is, in my view, difficult to get to 2% in an environment of no landing or soft landing, given that the ongoing pressures continue to stem from the service sector economy. So I think that makes sense, but it is noteworthy that the Fed has increased to 5.1% in terms of the median rate forecast for 2024.
Yeah, sure. Carl, you agree on that as we see 2-year yields lifting a little bit higher on the back of these forecasts?
I mean, I guess that sounds right. I mean, I don't see, I'm not sure that there's a whole lot of movement there. I mean, I think we know that they are looking to to stay tight for a long time, and so maybe the bump confirms that. So I think that's about what I was thinking there. But I do think, yeah, it definitely confirms a sort of high long uh, baseline that we're going through.
Okay. I did want to get a little bit into the longer term here. This gets a little
Yeah.
academic at this point, but if you pull up the Fed's summary of economic projections, and let me just go ahead and flash it on the screen because I
Right.
think this is important to get everybody on the same page here. So here it is. Let me blow it up for everyone. So this down here. So first of all, this is what we were talking about earlier. Let me get a little bit bigger yet. So this is what the Fed is expecting for rates to end 2020. They bump up 2024, they bump up 2025, and they're still the median is still expecting to be at 2.9 at the end of 2026. So this is, if you trust these forecasts and if you think that the median is representative, this truly is higher for longer. Um, but then, the Fed talks about this thing called its longer run
Right.
expectation, which is basically representative of what they think neutral is, right? So they think neutral is 2.5% in the median. Uh, adjust that for an expected inflation rate of 2%. They're saying that they think R star is 0.5%. You have seen you don't see it in the median here. The median has been steady, steady, steady since about 2019, but you do see it in the central tendency
Uh-huh.
and in the range, right? So here you have more upward movement in the central tendency. So the central tendency now moves to 2.5% to 3.3%. When we talk we're saying here is all of the forecasts, but drop out the three highest and drop out the three lowest. So there's some upward drift in the central tendency, and um, let me just scoot over here in the document. If you look at there's somebody end of the distribution who is really, really quite concerned about R star and seemingly sees some real structural changes in this economy because somebody is talking about a 3.8% longer run uh, nominal interest rate in the United States of America. What do you make of that, Carl?
Well, so it'd be interesting to see how it is and how it's moved. I think it's bumped up too. I mean, the what I'm thinking there is it's probably not looking at inflation being uncontrolled. The worst we see on that was what, like about a point off in the sort of longer run tendency. So
Hmm.
probably we've got somebody who is just worried about the size of deficits going
Mm,
forward. I mean, I think that's what that's got to be, right? So I mean, the only thing that I can think of that is really moving up on R star is the perspective. Kind of, it might depend on how you think the sort of new wave of deglobalization is going. Most of the people I'm talking to think if anything that's likely to drive down interest rates is because it's going to make new investment a little bit more difficult. It's going to make technological progress a little bit slower. That tends to drive down, R star in the long run. But the other factors that drive down R star, demographics, are still going in the same direction as they were. There is still a lot of savings in the developing world. That doesn't look like it's about to change. And so underlying most of those things, the only major shift for the U.S. is in its deficit position. And if you think that long-run real interest rates are going up, which is what I think I was getting from that longer-term projection there.
I just asked John, Carl, do you think that R star is 0.5%, or do you think it might be higher?
Um, no, so I mean, 0.5 is low. I mean, like, so I do think
Oh,
in the
yeah.
I do think in the 1.5 range is not unrealistic. I mean, I think that we're probably going back to a world that is more or less like what we had before COVID. That's my baseline right now. Now, I mean, of course, we do have a lot of things going on. We have the deficit going on. We have deglobalization going on. But when I try to figure out which way these things cut, the deficit cuts higher, deglobalization looks like it cuts a little bit lower, and the net to me looks similar. Now, I mean, I'd be happy to hear other people's projections. I've heard some people saying that they see a complete sort of sea change in long-term real interest rates, but that's just the fundamental economics don't show that to me. Maybe the markets have a little bit different.
sure. And I did want to point out, just bringing a little historical context into this. You know, you could argue that a little bit of an uptick in these return to something more normal, right? Uh, these median estimates have been particularly low, like I said, since 2019, uh, and there had been since that period growing consensus building around that. But for a long time, people didn't think that RSAR could possibly be this low. So you even go back to like 2021 and you look at the distribution. So uh, the climb that we've made here, really since like December 2021, is uh, so the highest projection back then was 3%. Then the high started creeping even higher in 2022 to 3.3%. Then there was somebody who thought, again, this is nominal neutral, not real neutral. That somebody in June thought it was 3.6%, and now we have it drifting up to 3.8%. So these are things that are happening distribution. It's definitely not the consensus thinking at the Fed. My view of the way Jay Powell thinks about this, uh, not an economist, by the way, but a guy who is very skeptical of the stars, including U star and R star, and is really kind of like a show me the money guy. Like, it's helpful to think about these things. I'm glad that I have a guy like John Williams of the New York Fed as my right hand man who understands these things. But really, I think it would be irresponsible to make policy off of what
Right.
some model is telling me. And I think we really just need to go slowly and see, is inflation coming in, and if it is, adjust rates accordingly. Uh, it that seems logical to me. Do you guys agree that that's the way to make policy in this environment?
Yeah, I
I
mean, I
think,
think,
John,
yeah.
that makes a lot of sense. And our mutual friend Claudia Salmas talked a lot about this, the fact that R star and Nehru they're so difficult to even measure. And at this point, they could be even irrelevant. And combine that with the inaccuracy, make it difficult to really give them many credence. My only point is that 0.5 seems insane. It seems very low to me, and maybe out of the realm of reality. I think the summary of economic projections is absolutely projecting the best possible scenario, and hopefully we get that. We're so far so good because growth is getting upwardly revised, inflation is getting downwardly revised. But I think that the higher for longer is de facto there, and it seems to me, at least from what we saw in the chart that you just pulled up, is that a lot of FOMC members agree that our star is probably higher, that rates are going to have to stay higher than they have been in the past. And if you look at the forecast going out for the next couple of years, John, you can see that we don't get below 2%. I mean, we go near 2%, but there's going to have to probably be an implicit change to the target. So yes, we average 2%, but of course that means going below 2% as well as remaining above 2%. So I think going into next year and the following years, if in fact we continue this trend, which I'm not a believer. I do think that economic cycles are precisely that by definition. They are cyclical. So because we have not seen a downdraft yet does not mean that it is never going to occur. Um, I think that the long variable lags of probably 550 basis points in total rate hikes, because I do think we get one more hike. Maybe not this year because we have the labor union strike, we have likely government shutdown, and we have a surge in oil prices, which is a tax on all consumers. That could postpone the additional 25 basis point hikes. But in my view, the Fed is probably going to stay at 5.5 for an extended period of time, unless and until we get a change in the consumption habits of the US consumer, because that is de facto what is the main driver of core PCE.
So Kathy, when you say 0.5, are you saying like 0.5 like real rates? Do you mean like a 2.5 like long run, or are you saying like going all the way back to like when the Fed funds was 0.5? Which one are you saying
Uh,
is unrealistic?
oh,
I
R
just wasn't
star.
follow.
John
Okay.
Taylor's R star of 0.5 doesn't seem realistic to me. And I think that if we're even going to consider Nehru, which I think, John, we probably don't want to, but Nehru is probably higher as well. So in that case, we do need unemployment to go higher, for inflation to decelerate in a more meaningful way. And that makes sense to me, even though it's been almost wholesale discarded by a lot of, the zeitgeist in academia
Right.
right now. My view is that to change the habits of consumption, people have to change their job outlook, and the job outlook remains remarkably robust. And more than 70% of core PCE is tied to is tied to service sector inflation, not goods sector inflation. So I think that consumer confidence so the Fed has to break something to get to 2%, in my view. I think that the summary of economic projections should be taken with a grain of salt. The Fed has historically not been very accurate with regard to its forecasts, especially on inflation. So what I'm advising our investors, John and Karl, is to take advantage of these opportunities to hedge portfolio positions, especially in heavy risk assets that are interest rate sensitive. Hold gold, hold cash, and accumulate defensive positionings, as well as buy tips, because I think real yields are more attractive than nominal at this juncture.
Yeah. So what I thought was interesting is the Fed is actually seeing unemployment go up less, under this median than before, which means that the Fed is kind of buying the soft landing here scenario, and um, and
I'm
so
just I'm just going to put that up for everybody as you talk about the unemployment projections. Go ahead.
right. So they did have unemployment going up, to 4.5, and now they're saying that unemployment is just only going to go up to 4.1. At least that's the median, and that's a very light, jump off of where we are right now. So that would be no effect essentially in terms of the overall economy. That wouldn't look like any sort of even mini recession, at all. I think the interesting thing, Kathryn, hear your thoughts on this, is that what we have seen is that the labor market looks looser. Job postings are down. People are saying jobs are harder to find without unemployment going up. Do you think that is what do you think that means? Do you think that's something that we should be paying attention to, or just, hey, that's a lucky break, but it's going to take actual layoffs to get people to change? You know.
Well, to change habits of consumption, Carl, I think people either have to fear for their losing their job, maybe lose their job, or at a minimum, not find it so easy to get another one. I mean, really, when you look at the real economy, maybe not in our space, but in the real economy with construction workers and nannies and service sector, it's still hard to find people. I mean, we have at StoneX, you know, investors that work in the economy, and they say, hey, it's still tough. It's really tough to find labor. So I think that it will take a change in the labor market perception to alter the habits of consumption, and that ultimately is what I think it's going to take to get inflation more sustainably down. Again, the Fed could change its target. I highly doubt, though, and I'd like to hear your thoughts on this, John and Carl as well, if you think the Fed would explicitly change its target before reaching said target, or if it could just be kind of a more implicit thing, like we're seeing here now, as you see in the summary of economic projections, kind of this slow trend. But as I say, so slow trend lower. And I'll finish with this. As I say, that the forecasts of the Fed are not famous for being exactly accurate. So I think we have to take this with a grain of salt. And the Sound rule, and I love Claudia Sound, I think she's fantastic. The Sound rule says that, if we get a 50 basis point increase or more versus the moving average over the course of 12 months, you're already in recession. So you're right, Carl. If the Fed's forecasts pan out, which take it with a grain of salt, but if they pan out, this is beautiful. This is the definition of a soft landing. In fact, I would argue this is a no landing.
That's that's intense. What was I gonna say? There was a question that you put back there that was particularly interesting. I've lost it a little bit here from that last one, but no. So yeah, I mean, I think you're right. Yeah, the Fed is probably a little bit overly optimistic about the labor market. Oh, one thing I wanted to get back to is talking to some of my other some other economists. Some of the things they see. So a thing we argue about a lot is how much extra cash people have.
Yes.
And by almost every measure, that's going down. Some of my favorite measures say that they're still pretty high. Some other people are not so hot on that. I like to look at how much cash is in checking accounts. Some of my friends want to convince me that that's all nonprofits and other stuff. I don't think I quite believe that, but cash in checking accounts is still high. By many other measures, though, personal savings has been very low. It looks like people are probably going to have to start, rebuilding some of that savings. And I think what I'm hearing, and this is more like market stuff, is that appliance sales are going down, like sort of new credit applications so some big ticket items are going down, and they're seeing people, especially in sort of like the lower third of income, kind of be hit by like the higher rates, like making so that they don't qualify for some of the things they would have qualified before. Now, this is like anecdotal stuff. This is people reading through market reports and stuff like that. But I think that's where, I guess, if you believe in a soft landing, you're hoping the action will take place, right? You're hoping that people will cut back on those big purchases, saying, oh, my credit card is already high, I just need to worry about paying it down right now, even if they don't get the layoff. So I think that's how you buy the Fed's scenario. It's a big thing to swallow, but I think that's what you've got to think is going to happen. Yeah.
No, yeah, I hear you, Carl, and you're right. And I think the market has wholesale swallowed it. So,
Uh huh.
I think that's where one can look at counter-cyclical portfolio policy. We don't have it in the government. Counter-cyclical fiscal policies usually, economic books say it's the way to go. Right now, we have pro-cyclical. So we have
We
full
do.
employment and we have 8.5% deficit to GDP. So we have pro-cyclical policy. So what I'm telling our investors is that hedge your bets because what is discounted right now is what the summary of economic projections shows, which is the perfect soft landing, meaning unemployment goes up just marginally. But when you look at history, does that actually happen? Is it very gradual like that? I think there's a lot to be wary of going into next year. And unemployment historically moves high quickly. It doesn't
It does.
do this lovely, 10 basis point increase as the Fed is predicting. It would be great if not. And I'll end with this point, Carl, which I like, and John as well, get your thoughts on. But this time is, I don't think, different. I don't think it's a structural shift. I think that the normal phases of the economic cycle have simply been kicked down the
Delayed.
line, delayed, kicked down the line. So the credit cycle, right? You see, you barely see a blip on the radar in terms of the most vulnerable asset classes, such as leveraged loans, which are risky, floating rate. You're starting to see, as you mentioned, some delinquencies, some defaults in consumer loans, banks tightening credit, but really nothing in comparison to what one would expect with 550 basis or 525 basis points in cuts over the course of a little over 12 months. Point being that I think a lot of it has to do with, and we all know the story, hoarding of labor. At some point that ends. Massive liquidity. At some point that ends. I think it's ending. I think we go year ends and guys, they don't have that nice cushion anymore in their checking accounts. Faced with higher costs of prices at the pump, faced with uncertainty, faced with the fact that you pay much more to get any type of loan, and it's harder to get. I think that will put a damper on what has heretofore been kind of this miraculous scenario, which I think has been pushed by the injection of liquidity, both fiscal and monetary.
I mean, yeah. So it's hard to say. I mean, so I have, I was with you completely. I've been slid over a little, a little bit
Yeah.
into the softer landing camp. I mean, because one way to look at it is, I think the lags that you're talking about, like we should be seeing tighter credit, we should be seeing, banks pulling back. That could still be in the pipeline, right? So I mean, as delinquencies, I think are really what's going to drive that even more than rates. And we see delinquencies going up and up and up, like in months. And as that goes, you're going to see some squeezing down. The question is, like how much overshoot do you get? Now, I'll be honest. I mean, you're right. Like perfectly threading the needle is rare, and so that's what keeps me kind of in Kathryn's camp, is just what's the precedent for actually perfectly threading the needle. The pieces, I think, are arguably there in terms of the fact that the labor market is slowing, but not rapidly. We have more like tightening of financials in the pipeline. Delinquencies are not shooting up, but they're going up. We're expecting, banks to tighten down. So there is like, this slow constriction, out there, but it's just, it's got to hit it just right. Like for you to get a soft landing. If there's any sort of overshoot, then I think you're right. So unemployment is self-feeding, and then once you cross, threshold, Claudia's threshold is 50 basis points. But wherever it is undeniable that once unemployment crosses a threshold, it is self-feeding, and it is very difficult to stop. And so that's really where you are. It is surprising too. The Fed seems to be leaning a little bit more on everything perfectly coming together. In a way, I think it's more rational than what they had before, which was that we're going to have 50 basis points increase in unemployment, but not a recession.
Yeah.
But not a recession. So it's a little bit more rational, but it is more in the I guess. It would be a first. It would be a first.
I think it would be a first, John.
Yeah.
I mean, has this ever happened before? I think it's historically improbable.
It is.
Right?
Yes.
But I think it's also
I'm not
But
denying that. I think that's the strongest argument. Is that like is that it's historically improbable. I'm on that. Yeah.
but at the end of the day,
Uh-huh.
disagree if you will. A lot of this comes down to luck, right? What we're talking about is vulnerability is increasing vulnerability is in the economy as policy starts to bite. That excess savings is coming down around the same time are ticking up. Unlucky student loan payments coming back. Bad timing, UAW strike. You have a confluence of things. But I look at that menu of things. I say not one of those things, no matter how vulnerable you think we are, is enough to push us in. So what's going to push us in? Uh, I don't know about 100% of the time, but most of the time when we go in, it's because something happens, something hits us, and inevitably we're a little bit off balance, right? So it takes us down into a legitimate downturn, but I still think it's a little bit of a question of luck because what is the catalyst going to be? Um, could we get lucky and skirt through this period of vulnerability without getting hit by such a catalyst? Yeah, I think it's definitely possible.
I mean, I don't know. I mean, it is interesting you say that. I mean, of course, obviously the last major recession. I mean, we had this little COVID recession, but then the last major recession, had a big catalyst, and then the what I usually call the dot-com recession. You could call it the 9/11 recession. I mean, there are clear like catalysts there, right?
Hmm.
But at the same time, you could argue that that's all a part of the unwinding, right? So in 1999, there's some people who thought, okay, we're on a new plateau, and so similarly here, people could say, oh, we're in a soft landing. But then what you see is suddenly, there's this big shift in, say labor hoarding goes away, and lots of companies say, oh, we're thinning, our workforce. Looking back, people could say that was like the dot-com crash. It was foreseeable because we knew, companies were carrying these heavy, workforces, just like it was foreseeable that dot-com would crash because there were these incredibly high valuations. But at the time, people were arguing, oh, it's a new plateau. So I think that's why, yes, in retrospect, you can always point to a single thing, but ahead of time, it's hard to know what's that single thing versus what's structural, right? What's a structural change? And so it would be an undoing of something that people think is structural that will be the catalyst. I think that's how we'll
I,
look back at it.
I have a thought as well, and adding to what Karl just said, if I were to pick something outside of the evaporation of liquidity and the people having to take out loans now at enormously higher rates, and having difficulty therein, combine that with the pinch of so many rate hikes and the relationship that historically exists with rate hikes and the unemployment rate, if I discarded all of that, I would say a conflagration with China would be the catalyst. I think that's maybe the most probable event. And I'll add one thing that we haven't really touched on that much. We have talked about the fiscal deficit, but when you look at interest payments as a percentage of GDP, they've doubled over the past couple of years, 1.5 years.
Hmm.
And in the meantime, when you look at ownership of treasuries, for whatever reason, China is decreasing. Okay, so I think that if we have some tumult with Taiwan or a breakdown with relationships in China, um, we are vulnerable. We are vulnerable given our deficit financing requirements. And the problem inherent in that is that you have to finance those with debt issuance, crowding out the private sector and keeping interest rates high for a long
Right.
time. So all of that in a nutshell brings down potential growth. So growth is slower, making it harder to service that debt. So I just think it's a long term issue. No one wants to touch it. It's a political landmine. We all know that, but it's a massive long-term issue, and I think it could be exacerbated and moved forward by any issue that comes out geopolitically with China.
All right,
Yeah,
guys.
I'll just
Hey,
say in the
I just I'll give you the last word, Karl, but I want to
folks are going to want to jump over
to Jay Powell's presser here. So I'll give you the last word, but before I do, thank you very much, Kathryn, for being with us, and thanks, Karl.
Yeah, I just want to say I do 100% agree on the crowding out long term. Long term, that is without a doubt our biggest threat to the economy, and we're going to be sensitive until we get that solved. And I think it's going to be slow growth is what I see from it. Yeah. So
all right, let's leave it right there.
Thank you to everybody, and happy